You know, a question I get sufficiently enough that it perhaps merits a video is just how did you create those security stock price simulations? And here's a slew of them that I've used, and you can use them to test things, moving averages, charting behaviors, a whole bunch of other stuff, but we've done those before and there may be more. Well, the question is, how do you create them? Well, the first thing you need to do is to create normally distributed random numbers. And there is a routine available in Excel, but it has been subject to some criticism given some autocorrelation and distribution properties. And there it's shown on the first line. If you were to write it, say, in BASIC, and I kind of like that because it gives you better graphical abilities, and it's also shown on the bottom in mathematical notation. So you got a normal distribution that's random. And acknowledging there's a lot of research and debate as to whether or not security prices are normally distributed in terms of returns, and generally they are, that if you take the return equation and then figure it for the subsequent price, you take the previous price and add 1 plus the normally distributed return, which could have a positive mean or not, and a given standard deviation. And you take that and multiply it times the previous price. You can start out with a seed price. I'm prone to use 100. You can use any one. And some observations are that while the mean return is linear across time, forgive me for the geometric approximation, but the standard deviation tends to be a function of the square root of time. I've shown an example. And you get a cumulative distribution that looks something like this across time. And heads up, not as bizarre until you start to think about it, is that the median, here shown as a yellow stripe on the right-hand side, the thin one you will, it will generally decline. And that must be the case because if you think about it, the security price is bounded by 0 on the downside, but is unbounded on the upward side. And wait, there's more. And that is a normal distribution usually will have extreme cases somewhere a little bit below -4, and on the upside around +4, plus or minus some change. And so if you had a standard deviation of 25%, you could get a negative stock price. But you know what? Make that a bankruptcy. Looking at a cross-section of exactly the same previous data shown cumulatively, we will see at cross-sections of 30, 60, 90, and 120 periods how the distribution does vary. And again, notice that the mean is greater than the median, and in this case I happen to use a mean of 0, and the distribution becomes more Poisson or gamma in shape and spreading out more so across time. On the upside, there's something I should mention. If you really look close, you'll see, especially in the 30 and 120 period case, there happened to be a little spike there at the end, and that was for storage properties because it was in excess of my matrix, and I made sure that it did not affect the subsequent prices we'll see in the program, which for your edification is shown here. And that line in particular I mentioned is at line 222. Sharing some of the good stuff, and maybe even interesting, with DrCinvests.